Welcome to Talk Tickers. We're here to cut through the jargon of earnings calls and give you the key insights.
Oh, great.
Today, we're diving into Dow's recent earnings report. We want to really understand their performance and what the outlook might be in this pretty tricky global environment.
Yeah, and Dow's first quarter certainly reflected that tricky environment. They reported net sales of $10.4 billion.
Okay.
Which is down year over year, and that was pretty much across all their operating segments. The main culprit, margin pressure.
Sugar pressures, okay.
But I thought I saw something about volumes being up.
You did. That's the interesting twist here. They actually managed their 6th consecutive quarter of year-over-year volume growth. So they are selling more stuff.
Huh. 6th quarter.
But, and this is the key part, the EBITDA for Q1 came in at $944 million. That's down from last year.
Right.
So those volume gains, well, they just weren't enough to offset that margin compression we talked about. Selling more, but making less on each sale, essentially. Gotcha. So more activity, but less profit squeezing through. Let's unpack what's driving this. Sounds like the big picture, the macro environment, is a huge piece of this puzzle.
Absolutely. Management was very clear on that. They used phrases like volatile macroeconomic conditions and pointed to those margin pressures hitting all segments.
And their outlook reflects that volatility.
It does. They seem to be bracing for what they called a lower for longer earnings environment. A lot of that seems tied to uncertainty around tariffs. You know, what that might do to demand down the line.
Tariffs are definitely a wild card, yeah. And Europe seemed to be a particular area of concern.
Oh, definitely. European downstream demand is still weak. We're talking significantly below pre-pandemic levels, maybe 20% or so.
Wow, still.
Still. And what's maybe more worrying is there's no clear visibility on when a real recovery might actually kick in over there. It's pretty uncertain.
Okay, so big macro headwinds, specific European weakness. Let's maybe drill down segment by segment. How did industrial intermediates and infrastructure fare?
Yeah, so they describe market conditions there as difficult, particularly rough in polyurethanes and construction chemicals.
Okay.
Net sales were down, both compared to last year and the previous quarter. Volumes overall were down too.
But wasn't there a small bright spot in volume somewhere?
There was actually a slight 1% volume gain overall. They put that down to better supply and industrial solutions and, you know, the usual seasonal bumps for building and construction stuff, plus de-icing fluids.
Ah, seasonality.
Exactly. And they did mention stable demand in energy and pharma end markets. But still, the operating EBIT for the segment was down. Lower prices, higher energy costs, and lower earnings from equity stakes all played a part.
Right. So a tough environment for that segment overall. What about packaging and specialty plastics? That's a huge part of their business, isn't it?
It is. And they weren't immune either. Net sales were down year over year there too.
Okay. What was the driver?
Mostly pricing pressure, especially on functional polymers. They pointed a finger at increased competition coming out of Asia. But here's another twist. Volume was actually up 4% in this segment.
Oh, really? How come?
Mainly because a PEH unit, a polyethylene unit, came back online after being down for maintenance.
Ah, okay. Operational factor.
Right. But even with that volume improvement, those higher feedstock and energy costs just kept squeezing the margins. Sequentially, net sales were flat, even though polyethylene sales themselves were down a bit despite higher olefins prices. So, complicated picture.
Very. And the operating EBIT.
Also down year over year because of those lower integrated margins. And down sequentially, too, mainly due to higher input costs, although that was slightly offset by better earnings from joint ventures.
Okay, quite a bit going on there. Let's move to performance materials and coatings. I remember hearing something positive about silicones.
That's right. Good memory. They actually hit their 6th straight quarter of growth in downstream silicones. That's a positive trend.
Definitely.
However, the overall segment volume actually dipped. That was because of lower volumes upstream in siloxanes and acrylic monomers.
Upstream versus downstream?
Yeah. Exactly. So net sales were down year over year because of pricing pressure on those upstream siloxanes. But sequentially, sales were actually up.
Okay, why the sequential increase?
Driven by, again, seasonal demand for building and construction coatings, plus pretty resilient demand from electronics and personal care markets.
Right, okay, so mixed results across the board, really highlighting those pressures. It sounds like Dow isn't just sitting back, though. They're taking action, right?
Oh, absolutely. They're not just hoping things get better. They've announced a pretty significant cost-saving program, targeting at least $1 billion in annualized savings by 2026.
$1 billion? How are they planning to achieve that?
Well, a big piece of it, unfortunately, involves job cuts. They're looking at reducing their workforce by about 1,500 roles.
Wow, that's substantial. And are they adjusting investment plans too? I heard something about a project delay.
Yes, exactly. They're hitting pause on the construction of their big Path to Zero project up in Fort Saskatchewan, Canada.
The net zero ethylene cracker.
That's the one. And as a result, they're cutting their planned capital expenditure for 2025 pretty significantly, down to $2.5 billion from a previously planned $3.5 billion.
That definitely signals a more cautious stance on major spending right now.
For sure. It suggests they're conserving cash and maybe not seeing the near-term demand to justify that level of investment just yet.
And this caution extends to existing assets too, particularly in Europe.
Yes, they're expanding their European asset review. They've already flagged 3 specific upstream assets that could potentially be idled or even shut down completely.
Which ones are those?
An ethylene cracker in Bolin, Germany, chlor-alkali and vinyl assets in Schopau, also Germany, and an upstream siloxanes plant in Barrie in the UK.
Okay, so some potentially significant restructuring in Europe.
Definitely looks like a rationalization effort, likely driven by that weak demand and the higher energy cost situation over there.
So cutting costs, delaying big projects, reviewing assets, but they also have some cash coming in, don't they?
They do. Quite a bit, actually. They expect $2.4 billion by, I think, May 1st from that infrastructure deal with Macquarie Asset Management.
Right, the infrastructure transaction.
And there's potentially another $600 million coming later this year from the same deal. Plus, they're anticipating over $1 billion in cash from the final ruling in the Novier litigation.
That's the long-running legal case, right?
That's the one. So add it all up, and these moves could provide something like $6 billion in near-term cash support. That gives them a lot of financial flexibility.
$6 billion is a serious cushion. Okay, so with all this going on, what are they guiding for the next quarter, Q2?
Well, for Q2 2025, they're expecting EBITDA to be roughly in line with Q1 levels.
Flat sequentially, basically.
Pretty much. They do see some improvement in volumes and margins coming, but, and there's always a but.
Yeah.
Those gains are likely going to be offset by higher costs from planned plant maintenance shutdowns and also some startup costs related to new growth projects coming online.
So improvements likely eaten up by costs in the short term.
It seems to be the expectation. Though they do think the benefits from those cost cuts we talked about will start to ramp up and become more noticeable as Q2 progresses.
Okay. Despite all these headwinds and actions, Dow does seem to lean on some core strengths, doesn't it?
They definitely emphasize those. Things like their global footprint, their generally low-cost asset base, especially in the Americas and the Middle East,
right,
and their flexibility when it comes to feedstocks. They see these as key advantages for navigating, all this geopolitical volatility and shifting trade flows.
And they mentioned something about USMCA compliance.
Yeah, they estimate over 95% of their North American volume is compliant with the USMCA trade agreement. That could provide some insulation against certain global trade disputes, perhaps.
Okay, so if we try to boil this down for someone tracking Dow, what are the really critical takeaways from this call?
Well, I think it paints a clear picture of a company grappling with some serious macro challenges. Profitability is under pressure, even though they're managing to sell more product.
Right.
Their response is pretty aggressive. Cutting costs deeply, pulling back on major investments like Fort Saskatchewan, and getting serious about rationalizing assets, especially in struggling Europe.
And the cash inflows are key.
Hugely important. That potential $6 billion provides a vital safety net and flexibility during what could be a prolonged downturn. It buys them time and options.
So the focus is really on navigating this tough period.
Exactly. It's about cost control, optimizing what they have, and leveraging those unique cash opportunities. Investors really need to watch if these measures can truly offset the margin pressures and if those low-cost assets, particularly in North America, hold up as an advantage. The commentary on tariffs impacting consumer demand is also something to keep a close eye on.
Absolutely. Okay, that brings us to the part of the show where we brainstorm some potential trade ideas. Just spitballing here. Remember, this is definitely not financial advice, purely for discussion.
All right, standard disclaimer applies. So, thinking about Dow's situation, they're aggressively cutting costs, especially in Europe, and they've got this big slug of cash coming in, over $3 billion, likely by year-end, for the Macquarie deal and Novier.
Okay. Where are you going with this?
Well, here's a thought, maybe a bit out there. How about a pairs trade? You go long Dow, betting on their specific catalysts and cost discipline.
Right.
And simultaneously short a basket of, say, European chemical companies. Maybe ones that are more leveraged, don't have these kinds of cash windfalls, and are perhaps more exposed to those high energy costs and weak demand in Europe.
Interesting. So playing the relative strength based on balance sheet and specific actions.
Exactly. You're betting that Dow's proactive steps and cash cushion allow them to weather the storm better, or maybe even outperform their potentially more strained European competitors if the downturn persists.
What are the big risks there?
Obvious ones are, well, what if European demand snaps back much faster than expected? That would hurt the short side. Or maybe there are hiccups with Dow getting that cash delays in the Macquarie deal payouts or the no VA settlement getting tied up somehow.
Right. Unexpected issues.
Yeah. It's definitely not a low-risk idea. It's playing on relative financial health and specific regional economic weakness. High potential reward, but definitely comes with significant risk.
Definitely food for thought. Okay, that wraps up our deep dive into Dow's latest earnings call. We've covered the numbers, the strategy, the headwinds. Quite a lot to digest.
Hopefully this breakdown has given you some valuable context and things to think about. But as always, please do your own homework before making any investment decisions.
We'd love to hear what you think too. What's your take on Dow's strategy? How do you see things playing out in the chemical sector, especially with tariffs and European demand? Let us know.
Yeah, absolutely. Thanks for tuning in to Talk Tickers. We'll catch you on the next deep dive. Until then, keep an eye on those pickers.